Where are we with fiscal stimulus? It lasted a little bit longer than maybe we understood.
Well, much bigger in terms of the take-up of some of these Biden plans was much higher than what anyone anticipated. So if you look at it, at this time last year, the consensus forecast was that the US economy would be contracting by now in a recession. Instead, for this quarter, it looks like the US economy would have grown by more than 3%. I can't remember a period in history where the forecasters have been this wrong in terms of what they were predicting and what actually happened.
And substantially above trend.
Yes.
3% is substantially above trend.
Yes, exactly. I think the US trend is closer to 1.5%.
Yeah.
This is like 3%. So why did this happen? As you already pointed out, that a lot of this was because the fiscal stimulus was much bigger than I think what people expected. There are some estimates that the fiscal stimulus may have added 1.5 percentage points to GDP growth. That's a substantial amount, like in terms of adding to economic growth. And then the US consumer has ended up being much more resilient, partly because so much of the borrowing that the US consumer does now is really at fixed rates. So it takes a long time for them to refinance and for the higher rates to bite them. On the other hand, they're earning much higher interest on their deposits in the bank. So it's ended up being much softer, the blow of higher interest rates. But I think the fiscal shock in some way, which is so much bigger than what anybody had in their models a year ago, is the main reason why the US economy has done far better than what people expected. The only problem is this, that you've done this once again by financing it by loads of debt. The bond market is beginning to sort of get troubled by the amount of supply that's coming their way, leading to even higher interest rates. And then this fiscal stimulus is bound to fade. Also because some of the stimulus is that some of these pandemic programs that we had were still rolling on.
But it's not just the bond market that's paying attention. Certain members of Congress are as well, as we're proceeding toward shutting down the government because of that issue. What does that portend for the U.S. economy?
Well, if there's an actual shutdown, obviously sort of it begins to detract from growth. But I think that so far most people think that the impact will be rather modest and the worst will be averted. But every week that we have the shutdown, it'll obviously have an impact. The issue here is that no one is doing this on any great principled way, which is the fact that, as we have discussed in the past, that if you look at the last 50 years, the US has run a budget deficit practically every year in the last 50 years, no matter if you've had a Republican or a Democrat president or whoever has been in Congress. And that's what's happened, that because for 50 years we have run these deficits, the attitude has come to be of policymakers that deficits don't matter.
And one of the changes has been the interest rate. If you go back 2 years, 4 years, 5 years, we were told by policymakers, don't worry so much about the deficit. It doesn't really matter, as you say, because interest rates are essentially zero or very close to it. They're not zero anymore. So what does that start to do about U.S. expenditures and our budget if we have to have that large a debt service?
I think at some point in time, it's going to start to impair other spending, including social spending, that because this cost is going to go up and up, right? That's what the bond market is currently pricing in, that we're going to have rates for higher for much longer. So at some point in time, then that begins to eat up a significant part of the total budget. And if you look at the cross-sectional evidence of what happened in other countries, once interest payments as a share of the total budget exceed a particular amount, then the pressure comes on to cut social programs. As I said, the central question here is this: when do international investors say enough is enough and they stop funding this kind of deficit? We haven't quite reached the point as yet because the dollar is still relatively strong. But at some point in time, I think we could reach that point, and that's when it really begins to count as far as the US is concerned, that you can't run budget deficits of 6% of GDP every year and have a current account deficit which is 3 or 4% of GDP a year. A twin deficit of 10% of GDP a year, at some point in time, maybe much sooner than we think, that will begin to count.
Ruchir, there's a follow-on question, I think, to when do investors stop funding the deficit, which is if they're not putting the money into U.S. Treasuries, where are they putting the money? If you look around the world right now, some prospects, such as China, for example, does not seem to be as attractive a place for foreign direct investment. So where does the money go if it doesn't come into U.S. Treasuries?
Well, that's what's really helping the U.S., that it continues to be perceived as the best house in a bad neighborhood, right? Because you got, in terms of China in trouble, Europe, the perennial problem child of the global economy. It's the first country to sort of enter a recession, possibly even in this cycle. So I think that you're seeing some other signs of life in other places, like Japan is doing much better. It's done much better this year. I think some of the emerging markets outside of China have done relatively well. These include places like India, include places like Indonesia, Mexico, Brazil, and even some places in Eastern Europe like Greece and even Poland. These countries have done well. Still relatively small to absorb too much capital, but you can see that this sort of new era is beginning. It takes a while for this to happen. But I think that there will be a time, I think soon this decade, when you'll see a much better environment for international investing because the dollar stops appreciating. Currently, the dollar keeps reacting to the fact that yields are going higher. So it's like, okay, we must bid the dollar higher. Having said that, it's quite interesting that even though the perception is that the dollar is appreciating, compared to the increase in yields that's taken place, the dollar hasn't gone up that much this time. The dollar is still well below the highs it hit in September, October of last year, if you look at the DXY.
When investors start to look for other places to put the money, as you say, for example, India, Japan, Indonesia, places like that, often you get into geopolitical questions. Not so much in Japan, but certainly Vietnam is an example where that's true. And India, we've talked about before. Is Modi getting his act together, as it were, to make India a more attractive place for foreign direct investment? In the past, you've expressed a list of some questions about that.
Yeah, I think that like in India's case, the entire issue is that there's still a very strong socialist DNA, no matter which government is in power. Having said that, in India, we've seen some pretty significant revolutions that have taken place. The entire digital revolution that's taken place in India, I think that's very significant in terms of how it's benefiting people out there and how even the welfare programs are now reaching the people in a more significant way. And just the fact that India, in terms of currently, is seen as the one large emerging market where you can hedge your bet rather than be in China, sort of really helps India a lot out here. The only issue with India, but this has always been an issue, is that it's the most expensive market in the world just now. If we fret about the multiples of the US market being high, India is at a 20% premium to even the US market, which is arguably the most expensive market in the developed world. So I think that the only issue is that expectations out of India are very high, but the fundamental Indian story, driven by digitization, demographics, and geography, I think is still very strong.